Hopefully, everyone had a great and relaxing holiday season and new year. We are back at it. No rest for the weary. Um, for, I guess, a couple just housekeeping items before I kick it off to Mike. First of all, we do take questions. We keep this to a half hour so people can digest it. It's not too much, but questions just put in the question box. I'll field them as they're appropriate and try to get to them. Of course, anything we don't get to, we can circle back with later. We will be sending this out to everyone. So feel free to share it with anyone you think would appreciate it or rewatch it many times to learn more Mike Horwath's knowledge, but that probably won't be ready through compliance till next week. But keep a lookout; this will be coming. So, as you know, one of the things that we are vigilant and feel very important about is client education. We want to empower our clients to not just trust us, but to also formulate their own thoughts and opinions and give them value every time and every opportunity we can. So we've been accustomed to getting our head of investments, our chief investment officer, Mike Horwath, who you've seen writings, and I think today, I believe, Mike, correct, your quarterly newsletter is coming out, so you have even more Mike than you can handle, guys. So with that said, I'm going to mute myself. I'll take questions or chime in as appropriate. But Mike, it's all yours. Do what you do best, my friend.
Beautiful. Well, thank you, Andrew. Happy New Year to everybody. This is our Q1. It's really our 2024 recap. As Andrew said, we like to typically on a quarterly basis, really put together a lot of content, in different ways that we can share with everybody. One of which is this. It's a 30 to 45-minute webinar, but we like the last 15 minutes to be, as much interaction as we can get, questions or thoughts or anything that we can kind of field from you guys, and we'll be happy to take. But I do have some prepared stuff, as I always do, to go through what happened in 24. The theme of my newsletter that'll come out later this afternoon is kind of just a recap, and it's all about predictions, right? I hate predictions. You've heard me say it multiple times. If for those of you who've been with us for a while, I hate it because I don't think people do it the right way, and I think they constantly are moving the goalposts. But I think it's a helpful exercise to say, hey, look, what did we predict in 24? What happened? Why? What are we looking at in 25? And kind of measure ourselves and really kind of have a very honest conversation, and really helps with a couple of things. I always talk about it helps with the planning side of things, because when we're working on the financial planning aspect, we're talking about inflation and expected rates of return. Well, that's all driven on forward-looking expectations. We need to understand where things are today and expected to go, so we could build in these projections from inflation, from rates of return. And then obviously for my team, it's portfolio positioning gets driven heavily from what our outlooks are and just really fundamental beliefs. So going to go through a lot of that today. Please share any questions you have, and if you have time to read the newsletter that comes out this afternoon, please do. It won't hurt my feelings if you don't, but it's there for you. So going into just a recap of 24. Another strong year for risk assets, right? I think that is the main thing. Risk assets had another strong year coming off of a really strong 2023. We focus on global equity markets. You're looking at about 17.5% on global equities. I think what you're going to see is the S&P 500 getting most of the attention, right? It's going to be even just the NASDAQ, right? Those large growth names getting most of the attention. The Mag 7 stocks, the top 7 to 10 stocks in the S&P 500, they have driven most of these returns. And you could see for 2024, about 25% on that index. And really what happens is, how do you get from 25 in US large cap down to global equities, right? The whole equity market globally down at 17.5. And really what you see is anything outside of those 7 names, while returns were positive and at points pretty strong, not to that extent. So small cap, as an example, had a really good run in November after the election, pulled back a little bit in December, landed around 11.5 for the year. Internationally, we've known for a while, we've spoken about it, that we are underweight fundamentally to the international markets. We own some. We fundamentally believe you should have some exposure. We have a belief around why we do it and how we do it, but you'll see, we're way underweight international, and they had a rough 2024 relative to US equities. Fixed income was the interesting one. Nobody wants to talk bonds, right? They are boring, but they are important, right? They are typically a ballast to our portfolio. They provide income. They are important parts of the investment landscape, and has been a very turbulent couple of years for the fixed income market. And for 2024, we saw about 1.25%. The interesting part about fixed income is the Fed cut rates 3 times, a total of 100 basis points. And we'll go through this again. But the interesting part is that the 10-year Treasury yield started the year around 4% and ended at 4.6-ish%. Mortgage rates rose throughout the year. So conventional wisdom, and we'll hear people say it all the time, is that, well, the Fed's cutting rates, everything's going to come down. Well, sure, the Fed funds rate can come down. It doesn't mean bond yields across the spectrum are going to be coming down. And we saw that across the board. So those yields rising on the 10-year were a headwind to fixed income. So at points, I think it was September, that we saw fixed income, the US ag as a good proxy, up over 5% on the year. Over the next 4 months-ish, we saw that pull back to about 1.25. We'll talk a little bit more about fixed income as we go forward, but it was an interesting year for the bond market because most investors have some semblance of fixed income allocation. And I don't think it gets a whole lot of attention, just given what stocks are. They are typically a bigger weighting to portfolios. They are the growth driver, and they're just more interesting to talk about in general. But the theme is equity dominance again, right? And I've had interesting conversations as to why people think that, right? On one hand, I keep hearing that artificial intelligence, right? That it's all AI. I hear one thing, well, we have a new administration coming in, they're going to be more pro-growth. Okay. Markets are way overvalued, Mike. People are just lost their minds. I think all of these are kind of in silos, different reasons. And I think really what needs to come back to is it's just earnings, guys. Earnings have been so powerful in earnings growth within, especially the US large cap space, that while markets aren't cheap, we'll look through that a little bit, but earnings have warranted the equity rise. Now, part of that is this rotation to AI, right? You see NVIDIA. Why has NVIDIA risen the way it has? Well, because demand for their chips has exploded. Their revenue is quadrupling virtually every single quarter. Earnings at the bottom line are just growing very, very quickly. So earnings were very impressive. You'll see it on the right-hand side. Not only do we see 24 having really strong earnings, right? Almost double-digit earnings growth relative to 23, 25, 26 projections from a bottom-up perspective for the S&P 500 are almost double digits as well. So continued earnings growth, and this is what you're seeing priced in the markets. It is still a very top-heavy market. If you look at what has driven returns, people want to talk, oh, the S&P 500. It's not even the S&P 500. I think that's an important part here. 493 names in the S&P 500 are almost irrelevant when you look at 2024. It doesn't mean entirely, it doesn't mean every single one, but there are 7-ish names that are continuously driving portfolio returns, and they're the names you know. They're the NVIDIAs, the Metas, the Teslas. The growth in those names at the weightings they're currently at in the S&P 500 as an example, and even in the ACWA, right, the All Country World Index, they are still very large weightings. It is a top-heavy market, and it was a concentrated return market. So U.S. large cap outperformed U.S. small cap, and those two combined as the U.S. outperformed emerging, outperformed international in the developed space. But even when we go back to the very beginning and say U.S. large cap driving returns, it's a few names driving returns. And to me, I want to see a rotation within that, right? Because I think that rotation, and it's not that those top names aren't going to still be the leaders of the market. They're not, they're going to still be extremely profitable. The margins are very impressive. They are still growing very quickly. but you want to see a broader market, the breadth of returns to be a little bit higher. But as we look forward, I think the question we get is, can this continue given where we're at on the S&P, given where we're at on just equity markets in general? Can small cap recover? We are constructive on equity markets. Fundamentals still look strong. There are risks, right? If we're going to go through what those risks are, there are plenty. You think about, if there's a pullback in any semblance of earnings, if there's some sort of global trade conflict that could interrupt earnings, could potentially cause inflation spikes. Inflation spikes could leak into the Fed. All of a sudden, higher rates or rates that are higher than markets expect could, squeeze valuations a little bit. There's all these could, but if we're just saying from a fundamental perspective, earnings and earnings projections, margins look really strong. Labor looks strong. There's a lot to like. Doesn't mean you ignore the concerns, but there's a lot to like. I think this is a helpful illustration because the amount of times I've heard that, well, equities are just really, really expensive. And I'd argue that they're not cheap. I don't want to say that they're cheap, but these numbers reflect two different time periods, right? This is the beginning of 2022 and then at a point in December. And what you see is the S&P 500 price index, right? So at the beginning of 22, we were around 4,800 on the S&P price. In December, we were around 5,800. So clearly we had some sizable growth between those two dates. And if you remember, 22 was a bigger pullback during the inflationary and the Fed hiking cycle. 23 was a good year, 24 another good year. And what you see as a second bullet point is the forward price to earnings ratio, the same. So the market has appreciated as much as it did over the course of those really 3 calendar years, right? As 1 down, 2 positive. And the valuation multiple on a forward-looking basis is the same. And why is that? And it just comes down to earnings. The earnings have driven that growth, and that growth has warranted a higher price on the S&P given the same valuation multiple. And if you start to look forward into 25 and then 26, and you start doing these exercises, you start to see, okay, well, maybe the valuations aren't as stretched. Once again, not cheap, but they're not that stretched relative to what I think people feel just given the returns in markets over the last couple of years. So I think that's an important point to understand what's happened and understand where valuations fit into this entire spectrum. Flipping to the fixed income side, the Fed side, I think, coming into 24, the question was, will and when and to what magnitude would the Fed cut rates, right? They had just gone through this hiking cycle where they hiked rates into the middle of 23, and then it was paused. They peaked around 5.25, and then what we saw in September was they were ready to start cutting, and they cut 50 basis points in September, and then 25 in November and 25 in December. So 100 basis points, 1% was cut between the last 4-ish months, the last 3 meetings of 2024. But once again, the interesting part is that even though they cut, yields rose. What does that mean? And really one of the biggest things that happened towards the end of the year was you saw the rhetoric coming out of the Fed that they were comfortable with where inflation and unemployment were, but they're also kind of comfortable with where rates are. The expectation going into 24 is that, or 25, excuse me, is that rates are going to get cut, but how much? There have been points in time where the expectation was we're going to keep seeing another 75, 100, 150 basis points of cuts going into 25 and then into 26. Well, the Fed and their dot plots, right? Their dot plots represent what their expectations are moving forward for each of the Fed members. And what you're seeing is consensus that they're expecting closer to 2 25 basis point cuts. And why is that? Remember, the dual mandate of the Fed is balancing inflation and unemployment. And what we've seen is that inflation, you can see it on the right-hand side of this graphic, you have core PCE and then core CPI, right? These are just two different measures, very similar, but there are nuanced differences, but they've kind of plateaued. They've clearly come down off their high from 2022. but we've kind of plateaued. Here's the interesting part though, is the Fed doesn't need to get down to 2. The Fed is comfortable at, call it 2.5 to 3. What they want and what they'll tell you is they want an anchored inflation conversation. They don't want 3.5 and then 2.5, and then they're seeing, spikes at periods of time. They want to see an anchored inflation number that is somewhere in that 2.5-ish% range, right? Is it 2.75? Is it 2.25? Right? Just call it 2.5. They want to see an anchored inflation conversation. Now, if that begins to elevate, you're going to probably see a really, really slow pace of cutting. You probably won't see any cutting for a while. And then concerns will probably turn to, will rates get increased to fight it, right? That is certainly what we would call a left tail risk, right? Something we don't expect, but something we have to understand could happen. But I think that the Fed is sitting here saying they need some sort of lever. They need some sort of insurance policy that if unemployment increases, if growth comes down below target, right? That could be a problem, right? If growth starts to drop into, the 1-ish% range, or maybe even get close to flatlining, if not go negative, not what we expect, but if it does, what keeping rates steady will do is gives them an insurance policy, a lever that they can use to cut rates. I like to remind people that if they were to just cut rates back to the pre-22 levels, right, to the floor, they have no levers that they can pull if something were to break. So them taking their time cutting rates, given where economic growth is, given where inflation is, given where unemployment is, makes sense. No one should be overly surprised. We all maybe want rates to come down. People who want to buy a house would like to see lower mortgage rates. But there's an element of they need to be cautious with that. For fixed income moving forward, I think, look, our expectations about what it was coming into 2024. I think expectations need to be somewhere in that 4 to 5% return perspective for core fixed income. Your starting yields are a little bit higher, so a lackluster 2024 may mean a little bit better 2025 potentially. But what we're seeing is you have this starting point of, call it 4.5% on yields. That's a good starting point. It's a good expectation for forward-looking returns. But we'll have to see where the Fed goes, because some of these movements in the short term can help drive some of the returns. But mid-single digit returns should be in a fixed income investor, at least a high quality fixed income investor, its expectation as they look forward. I always like to incorporate this a little bit, because we start getting a little bit more questions, and naturally it happens when something rallies as it has, like something like Bitcoin, right? How do we view it? One, and we've put out plenty of content this way or this way. There's plenty of people internally that'll have one opinion versus another, but how do you view Bitcoin in the context of a portfolio? And, I think the conversation is always one end of the spectrum to the other. It's this revolutionary technology, or it's a Ponzi scheme, right? And like both sides of this equation are quite polarizing, right? Which probably is a good match for our environment today. But the answer is probably somewhere in the middle, right? I think you're going to have pros and cons on this. On the pro side, you're going to hear conversations around this digital gold asset, right? A store of value. It's got limited supply. It's not tied to U.S. monetary supply, right? Not concerned around inflation or debasement of a currency. And it's decentralized. I think a lot of these conversations people like. It's interesting. Blockchain's an interesting technology. On the other side of the equation, well, how do you value Bitcoin, right? I think that's always going to be a challenge for someone like Warren Buffett, right? You hear Warren Buffett and Charlie Munger talk about it. At the end of the day, valuing Amazon, valuing any business comes down to their cash flows, their assets. You can value that. Something like this, you can't, right? There's a limited supply. There will only ever be a limited supply, supposedly. So how do you value that? It's supply and demand. It could be driven on speculation. All of a sudden, there could be a big pullback given the swings we've seen. You'll see on the right-hand side, people have to understand that as volatility goes, it is extremely volatile for the good or bad within a portfolio. And I think when you look at it in the context compared to other asset classes in general, it is substantially more volatile. I think what you find though is that it has a similar volatility profile of like an individual stock. And I think that's the way, if you're going to use it, one, I think is you have to educate yourself on what it is, why do you want to own it? Is it a diversified source of return? Is it a differentiated type of exposure for your portfolio? Understand it, become educated. Don't just buy it because it went up. Don't sell it because it went down. Understand it. And then two, it's how do you weight it? Because I think if you're going to use it, you need to be very careful with weighting this in your portfolio. And I think you would weight it similar to how you would weight an individual stocks. I think that's, and that's a single digit weighting, right? And this is where, it's important to have these discussions, and we're always happy to have them, of how you can access it, how you can think about it. But we're still not at a point to mass roll something like this out for our clients. I still think there's too much volatility profile. We're still too uncertain around value, but we have the ability to help our clients gain exposure, understand it, and think about it from a weighting perspective, right? Because if you overweight it within a portfolio, I think your volatility is going to be substantially higher than what you probably want from an appetite standpoint. So that conversation is very important. Don't let the polarizing nature of it, come out. Just go learn, right? I think that's, be curious and learn about it, and make your own decision, but and understand about how it fits into the portfolio, in total. All right, so I'm going to go back to high school. So as a person who got straight A's in high school, this was it's always painful because it's hard to get straight A's all the time, especially in this world. But I wanted to give myself a report card, and I wanted my team to kind of come together around, how do we do thinking about 2024? What did we get right? What did we get wrong? So I think there's a couple of things, right? I think one of the predictions we said, or two of them, let's use two of them because they're kind of tied together. Interest rates are going to get cut and inflation's behind us. And both clearly came to fruition in 2024. I think interest rate getting cuts was a pretty obvious one. We expected the Fed to probably cut towards the middle of the year. They took an extra meeting or two than I would have expected, but they started cutting. We saw 3 individual meetings where they cut during 2024. Pretty standard right there. And then on the inflation side, I think the inflation issue it's not dead, but I think the concerns that people have of going back to 6-7% on an annualized inflation number are a little bit overstated given the environment, and we saw that come to fruition. Things started to flatline. You still see some pockets like shelter, which is housing in various ways, is sticky, but by and large, goods, things like that have really come down quite a bit. I think the election being volatile was a reminder from our side. It was going to be choppy. We saw in the summer months into August and September and October, we saw a bunch of choppiness relative to the rest of the year. Coming in out of November, I think you saw, I would have said, we saw less choppiness, especially after the election. Really what it came down to was that the election was resolved quicker than I think most people would have expected, which was good. So, this is what ends up happening. Especially the 3 months before an election, you're going to see the choppiness. We saw it, a lot of speculation. Obviously, the concerns around a contested election or close elections, many states being involved, but it got resolved quickly. And I think you saw a rally. Things had, cooled off a little bit in December, but the choppiness around the uncertainty started to wane a little bit. One where I fell in the middle was this fixed income conversation. I really felt going into 24 that fixed income would have another 3, 4, 5% solid year. And what we saw was there were points where it was above 5. There were points where fixed income was down 0. And what ended up happening with the rhetoric at the end of the year was fixed income pulled back from that 5-ish% return we saw kind of in August-ish down to, around 1.25%. So it was pretty modest from a prediction perspective, where I'd say, maybe a C at best. Like, it wasn't a 2022 year, but our prediction of a decent year for fixed income, I still think, looking forward, what I said before is kind of what I would have expected for 24 going into 25. A kind of that 4 or 5% single digit return is what I would expect and predict within fixed income. I think that is where you should have your expectations as well. And really the one that was unfortunately not in our favor, it was the equal weight US equities versus the cap weighted, right? So if you think about it, it's like an equal weight S&P versus the cap weighted S&P. And with those bigger names driving returns, the cap weighted outperformed, right? We saw the other 493 names underperform. We saw small cap underperform. All of these, anything outside those top 7, pretty much underperformed. Long story short, we're going to be running this one back for 2025 because I really do think that this is an important part to a sustained, what I'm gonna call bull market, but essentially a bull market. For our continued optimism, we need to see broadening of equity returns outside those top names. Those top names have driven earnings growth and profitability for quite some time now. In order for this to be sustainable, we need to see it start broadening. And we see the underlying pieces, right? And we'll talk about it here in a second, but we see those underlying pieces kind of starting to happen both in just US large cap outside those top names and in small cap. So we'll touch that in a bit, but for 24, this was by far the one prediction that we did not get correct for the year. So as we look to 25, what do we expect? One, we're running it back as lens for punishment. Equal weight S&P will outperform market cap weighted S&P. Doesn't mean that we don't think those top 7 names have the ability to continue to drive growth and they're not good businesses. That's not what we're saying, but what we're saying is that the other 493 names are going to start contributing. And the big reason why is we're seeing this earnings growth change where those top 7 names have earned their returns. The biggest reason they've been the biggest contributors to earnings growth. And now we're starting to see the other 493 names, these other sectors starting to catch up. We're starting to see earnings growth. Not many people know, but in small cap, they actually went through an earnings recession for multiple quarters where they had negative earnings growth. And now we're starting to see for Q1 and Q2 of 25, that change. And when we start to get similar contributions from the biggest names and the rest of those indexes, we start to see this reversion where we would expect broadening and a deeper breadth of return. So that's something that we are using as a theme. When you own the S&P 500, you're going to still own those biggest names. We still believe in owning them, but it's just more of this needs to broaden out. That's prediction 1. Number 2, we've got actually a lot of questions on the Chinese fiscal stimulus. It started to happen later in the year where you started to see this monetary and fiscal announcement from the Chinese different government entities saying, hey, look, they're trying to stimulate the economy. And we've gotten like the questions of, is it time to rotate to China? Because look, it's extremely cheap and it's been underappreciated for a while. But to us, a stimulus like this is kind of this Hail Mary type approach. We do not expect it to work in the sense that Chinese stocks outperform other emerging markets and certainly not the US within 2025. I see that stimulus coming up short, just given a few things. One, you see debt levels. Debt is such a problem within the Chinese consumer, mostly due to the housing problem. So there's such a housing issue, high debt levels, and what it's doing is killing consumer sentiment. And we don't expect the stimulus measures to really help until that's really, really addressed. So the Chinese stimulus will come up short is our prediction for 25. Gonna say that US GDP and core inflation both remain above 2%. You've seen core inflation in that 2.5% to 3%. We don't expect it to get down below 2% during 2025. And we expect the Fed's gonna be okay with that. Part of it is gonna be because we expect GDP, which if you look over the last couple of decades has trended around 2%. We're expecting that GDP continues to hang in there. We do not dip down into really sub-trend growth or dip into a recessionary environment. So we expect both GDP and core inflation to remain above 2% in 2025. And then lastly, our predictions, the Fed's going to cut rates 3 times, 25 basis points each, getting it down to 3.5% on the short-term rate. So we will see cuts in 25. We're going to say 3. Fed says call it 2. I do think that the Fed will get some pressure if we see any cracks in markets. They'll get pressure to bring it down. But I think by and large, people should not expect drastic rate cuts unless something drastically breaks, which is not our base case for 2025. Lastly, just touching on portfolio position, candidly, This has not changed much over the course of the last 6, 9 months. We still favor US equities over international. This is something that we strategically typically would do, being US investors and just leaning towards the US, but we have probably one of our highest overweights to the US right now, and it's just it's a growth conversation that we're having here. Even though valuations have looked more attractive internationally, it's still not where we're leaning into. We do think, the administration, if there is a pro-growth agenda, if corporate tax rates come down, if regulation drops, there could be this tailwind for this pro-growth, and GDP growth remaining pretty elevated. Certainly risks always involved, but that's something that we're keeping an eye on. We are still constructive on equity markets, right? We heard us say earlier that valuations, I think, may be a little bit overstated on the concerns. It doesn't mean that they're not a little elevated, but I don't think they're anything drastic. And on the right-hand side of the screen, what you're seeing is valuation is always a horrible predictor for short-term returns. So if you use valuation today over the course of the next 12 months, what you're seeing is there's really no correlation between what your starting valuation is and 12-month returns looking forward. So I think intuition would be that, well, if markets are extremely cheap today, forward-looking returns should be higher. Well, maybe in the long run, I would agree with that for sure. If markets are extremely expensive today, I would expect in the long run, your future returns be lower than average. But over the short term, over a 12-month period, that is not necessarily true. So even though valuations, I'd even say that aren't that elevated, I think valuation is just a really bad market timing tool to use. We are leaning a little bit into dividend-paying companies. Part of that is part of this theme of starting to rotate, just trying to trim some of those biggest names in the index to add to these other names that we're starting to hopefully see some earnings growth and hopefully some more rotation as we look forward. And semiconductors has been a core piece of our portfolio for multiple years at this point. Within fixed income, we're still constructive on high yield, some of the spread sectors that are a little bit higher risk. You're not being compensated all that much, but the positive to owning them at this point is that corporate fundamentals are really strong. Default rates are really low. There will always be, one-offs here and there, but by and large, we still like core fixed income, a little bit shorter duration and heavier into credit, right? Into more corporate fixed income outside of treasuries per se within fixed income. So I went through a lot. It's 12:30, so I wanted to stop there. Andrew, any questions from a Q&A perspective that we can walk through a little bit?
Yeah, I know we're short on time, so I'll ask the two questions together. I will also, it's worth noting that although you got straight A's, that report looked much like my grades growing up. Anyways, so two questions here. We'll answer them and then cut it because I know we're over time. You didn't mention any impact or expected impact from Trump policies, tariffs, things of that nature on the economy and markets. What's your take there? And what's your outlook for international stocks in 25, particularly given likelihood of tariffs and the political financial uncertainties in Europe today? So why don't you answer those two and then we'll close it up.
Yeah, they're both great questions and they're tied together. I think on one hand, we haven't mentioned it too much and we kind of lump it into there are risks, right? Tariffs to us are kind of a no-win situation, right? In theory, tariffs are a one-time step up in cost, right? So it's a one-time step up in inflation and somebody's going to pay it. Likely the consumer. The biggest problem isn't the tariff itself. It is the reaction to tariffs. It's the reaction from a global trade perspective that the global economy is so intertwined still, right? We talk about deglobalization, but globalization's still out there. People are changing supply chains given the last several years. They're trying to nearshore, onshore, but global supply chains are still important. Globalization is still important. The market, in our opinion, right? If I look at tariffs, that is a risk, right? If I'm lumping a bucket together, like that is a risk from the standpoint of it can become a tit for tat. And what happens with tit for tat is all of a sudden you have sentiment dropping. You have not only US growth or international growth, it's just global growth is going to suffer because of it. I think the market will provide guardrails, right? I think if there's one thing for sure, Trump has, stated that, he cares about markets, right? He does. And I think markets will provide a guardrail that if it goes too far, or if something happens, or if there's a potential policy in place that gets a negative reaction, it will be corrected. Now, doesn't mean that there's not still the risk, and it doesn't mean that everybody's going to listen to markets. But from our perspective, until we know what's going to happen, until we know what's actually out there, who's involved, what the potential conversations are, the ramifications, it's not the tariff that we're particularly worried about itself. It is the reaction to the tariff, which is always the problem. So it's in our mind, it's on our mind, it's something we're looking at. To us, we're not going to hedge something we don't know yet, right? We still be diversified, we still lean towards the US, but we'll still be diversified, but we're not going to hedge it if we don't quite know what we're talking about yet. Now, as regards to international equities, I look at tariffs in that conversation as kind of a global issue. But, if we just kind of set that aside, I do think policies from the Trump administration will clearly be geared towards the US. I think they will favor a lot of US companies. And it's kind of leaning into what our belief has been. It's been to overrate the US. I think you see some of the best performing businesses here in the US. You see growth levels strongest here in the US. I think within an international space, it doesn't mean that there aren't opportunities. I think that there's a clear difference. For us, we approach it in a specific way. Our preference in approaching international has always been in a concentrated, certain stylistic, active approach, right? Because we think there's opportunities, but we don't want to just own broadly, especially within emerging markets. We prefer active, we prefer concentrated, because you get exposure at really interesting things, right? I think companies like Novo Nordisk, right? Everybody knows these GLP-1s, whether it's Eli Lilly or Novo, massive industry that's being created there. Well, Novo's not a US company. We want exposure to that type of company if our active approach warrants going towards something like that, or Taiwan Semiconductor, something along those lines. And you can go through a lot of these businesses that are attractive. So for us, I look at the tariff conversation more as a global growth issue, less about do I own US or international. The international discussion to me is still very strategic and structural in the way that we own it. We are structurally overweight US. And when we own international, it will be concentrated. It will be focused on typically growthier types of businesses, which is not the average company international. A lot of international, especially in Europe, you think about, industrials, autos as part of that, banks, right? That's not what we're typically looking at. But at this point, we're keeping an eye on it, because I think this global growth conversation, if I'm saying GDP above 2%, I think if there's an all-out trade war, that prediction is going to have some trouble. So we'll see, of course, but it is certainly something that's on our mind. And it's really not only that, it's all policies, and whether it be taxes and regulation, all of that, as things gonna set off here with the new administration.
Mike, you did it again. Thank you so much for your knowledge and information. Folks, we do this quarterly. Again, we will be sharing it. We do a lot of fun educational events to keep you informed, and we appreciate everyone's time and hope you got value out of it as well. So thank you for listening in. Mike, thanks for your tutelage and knowledge as always, and we appreciate everyone. So thank you. Make the year a great one, and here's to another 20% year.
Take care.
That's my prediction. See ya.